Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Unit Trust Research. On today's commentary, we will be looking into the building concerns over the massive Chinese credit bubble. The amount of debt globally has ballooned more than 40% to $100 trillion since financial crisis, as companies took advantage of the record low interest rates artificially suppressed by the central banks to avoid economies slipping into a giant depression and to spur growth, according to the Bank for International Settlements. The same goes to the world's second largest economy. China's local government liabilities surged to 17.9 trillion yuan as of June last year, from 10.7 trillion yuan at the end of 2010, an increase of 67%, while Chinese banks' non-performing loans rose by 28.5 billion yuan in the last quarter of 2013 to 592 billion yuan, the highest since September 2008. Bad loans accounted for only 1% of total lending, the China Banking Regulatory Commission said last month. On the other hand, the country's corporate debt hit a record of $12 trillion at the end of last year, equivalent to 120% of GDP, according to the Standard & Poor's estimates. China's economic growth was then sustained at around double digit with their massive 4 trillion yuan stimulus, even as the European and North American economies were slowing. The stimulus provided funds for infrastructure projects and housing developments, driving employment in areas of manufacturing, steel, cement, and other sectors of the economy, but also aggravated excess capacity issues in these sectors and inflated the property bubble. Recently, China had its first onshore bond default after Shanghai Shahri's solar energy science and technology company, a distressed Chinese solar equipment maker, announced its failure to make a bond interest payment on notes due March 2014. Earlier, we have also seen signs of financial stress in China's giant shadow banking system. One, a 3 billion yuan China Credit Trust Company product that lent money to a collapsed Shanxi-based coal miner averted a default on its principal in January after being bailed out. The major trustee only managed to repay the principals with the interest yet to be paid. In mid-February, a similar high-yield investment product, backed by loans to a debt-ridden coal company, issued by Jilin Province Trust Company, has missed 5 interest payments. The coal company had applied for debt restructuring, which could allow technical defaults in which repayment is delayed. The default adds to worries over mounting risk in the country's financial system, but at the same time, also signals Beijing's willingness, albeit tentative, to let some weak companies fall. This sent a wake-up call to market participants and could inject some discipline into a swelling debt market, where the widespread assumption that even high-yielding investment carry an implicit guarantee from state banks. Investors will be more aware of risk and more selective in their investment choices. The problem of excess capacity in industries such as steel, aluminium, cement, and solar, coupled with the slowing Chinese economy, intensify worries about companies' ability to repay. Standard & Poor's Ratings Services said that loan quality will decline in 2014 as banks remain at risk from debt-laden local government financing vehicles and manufacturers with too much capacity. We also expect the level of restructuring and defaults to accelerate as companies sell assets and undertake mergers in a bid to pay their debts in coming years. Premier Li Keqiang said that China will develop a regulated regional borrowing mechanism during the recent National People's Congress annual meeting. Chinese authorities have also started a cleanup of the $6 trillion shadow banking industry and identified sectors of the economy in need of consolidation. Fixing overcapacity is once again made a priority as China vowed to rebalance its economy away from its investment-led growth model. Although China signaled that its policy focus towards reforms and rebalancing the economy rather than growth, it sets a growth target of about 7.5%. The target is to support stable employment and at the same time, provide support to investors' confidence that reforms will be implemented in a stable growth environment. On the other hand, the Chinese government maintains its proactive fiscal policy and prudent monetary policy stance. However, the effective policy setting will likely to be tighter than last year amid efforts to contain local government debt and control financial risks. In February, Chinese banks made 644.5 billion yuan worth of new yuan loans, significantly lower than the previous month's 1.3 trillion yuan, according to a data from the People's Bank of China. While total social financing, a measure of funds raised by entities through bank credit and other means, amounted to 938.7 billion yuan in February, well below the previous month's 2.58 trillion yuan. After the first but may not be the last landmark corporate bond default, coupled with the central bank's continuous efforts to drain liquidity from the banking systems, it is likely to see bond prices to dampen to some extent in near future. Credit risk will play a greater role in investment choices. We expect to see higher default risk premiums pushed by corporate bond default risk. The metal markets such as copper, zinc, and iron ore, in addition to the tepid economic growth in China, are weighed down by expectations of tighter credit for users of metals and for financiers that used the metal as collateral for borrowing. The anxiety has led to 3 days of heavy selling in the copper market. On the other hand, valuations for Chinese equities are reaching its record low, as financial industries price in a very significant crisis scenario which reflects shadow banking credit risk and corporate bond default risk. Essentially, financial markets will likely to remain volatile in the near term, with financial or credit risk weighing on investor sentiment. A proactive policy options and adjustments at an appropriate time and to an appropriate degree, coupled with an improving global economic outlook, may be a catalyst to rally in Chinese shares. Nonetheless, stock and credit selection is the key. Investors may wish to avoid sectors in China which are struggling with excess capacity, as they are poised to deleverage and consolidate. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Unit Trust. Tune in next week for more Market Watch videos.